Welcome to our High Rock monthly video. I am Scott Tomlinson, and with me today is my colleague and partner and the founder of High Rock, Paul Tepsich, as well as High Rock certified financial planning professional, Bianca Tomlinson. As you all know, we have the three investment models from which we apportion an allocation percent to each client portfolio, based specifically on our respective goals, the time horizon required to achieve those goals, and our tolerance for the risk and potential for volatility that we may have to endure in achieving our goals. Our well forecasts are intended to capture our long-term goals in a plan that becomes the basis for our respective investing strategies. We always stress the longer-term outlook for your time horizons, and although we do have to report your portfolio performance through each quarter of the year, we remind you that these reports are simply a snapshot in time, just part of the journey that ultimately takes us to our end goals. So June did see a better portfolio performance than May's negative returns, but we caution all of our clients that there may be more financial market volatility to come and some short-term portfolio value dips before we finish with this economic cycle. Now, we always manage risk first, because why would we want to take more risk than is necessary to reach our goals, and by doing so potentially put those goals in jeopardy. As you know, we focus on the return per unit of risk taken as a key metric in the management of our portfolios. The end of June is also the end of the second quarter and first half of the year, and all of our collective portfolios have responded positively thus far after a difficult 2018. Now, we will be sending out our quarterly summary reports. In fact, I think Bianca was doing that today, and the client notes that accompany those. As we always do, we also send out this table of benchmark indices that you see here so that you can compare your portfolio performance. Now, as always, many newer clients may not be as fully invested as longer standing clients. So if you have any questions about your specific portfolio composition, please do get in touch with us directly. Now, as we do have data that now goes back to 2012 for some longer standing clients, we have included this in our table in order to continue our longer term focus. In the short term, we may underperform the benchmark because of our cautious approach, especially given the current political and economic uncertainty. But what matters most is how our risk management allows us to be able to provide superior risk-adjusted returns over multiple years. One of our equity benchmarks, the All Country World Index ETF, has had an average compound annual total return of about 9.7% since October of 2012. Canadian stocks, as measured by the S&P TSX, have returned a little under 7.5% over the same period. And the Canadian Bond Index ETF has returned about 3.25% over that same time frame. So when we take all of these indices into consideration for the purpose of making comparisons, we use a percent weighting of what our portfolio's asset mix might look like. In this case, 25% global equity, 25% Canadian equity, and 50% Canadian bonds. So for simplicity, we assume a fully invested portfolio here, but that may not necessarily always be the case with our portfolios, especially if we are being more defensive in our risk management. Now, the benchmarks, if you had invested in the indices in the suggested weightings, would give you a return of 5.9%. Now, our High Rock private client example has had a total return of 6.02% after fees, and our fees would add an additional 1.15% in this case. So for an apples to apples comparison, a total annual average of 7.17 versus the benchmark of 5.91. Now, the benchmark indices have no fee consideration other than the embedded MERs that are built into those ETFs. Paul, any comments on the the performance or the index benchmarks before I go to the...
Nothing really to add, Scott. I mean, obviously, as the numbers show, we're clawing our way back from last year, and during the fourth quarter, really, it was when most of the damage was done to the markets, global markets, in the fourth quarter of 2018. But I think, as you highlighted, the important thing to look at, and I'm glad we showed it, it's coming on 7 years for this specific actual High Rock private client that we're showing, is multiple years, and that really is the focus. It's not a single quarter or even a single year. It is multiple years, and as you know, this client is clipping out 6% a year over multiple years. That's especially given the amount of cash they're sitting in. The last couple of years, this client has been, and most of our clients have been sitting in around 30% cash. So they're taking way less risk than the market and outperforming the market. It's not a bad return.
Yeah, and speaking of the cash, I mean, that is our defensive posture at the moment. Now, that will not necessarily last. And let's talk a little bit about what's going on in the global economy now. What will continue to drive our investment decisions, and certainly first up, and probably the most widely discussed issues these days, are what the U.S. Federal Reserve is doing with interest rates. In their recently released report on monetary policy last week, they indicated that in light of increased uncertainties around the economic outlook and muted inflation pressures, the committee indicated that it will closely monitor the implications of incoming information for the economic outlook and will act as appropriate to sustain the expansion. While further clues may come from the Fed chairman's testimony to Congress and the Senate, which actually start tomorrow. Now, the market is predicting a 0.25% cut in rates at the next meeting on July 31st with approximately a 94% certainty. So I think, Paul, we can pretty much assume that the likelihood is they'll drop rates by 0.25%, right?
Well, it's the market showing, and I think they probably will, given that they've postured that way. I think the upset, quite often markets find the path of least resistance is the path of most pain. So I think even cutting by 25 basis points might be somewhat upsetting, but the language after the cut would be very key to look at, as you pointed out, as will Chairman Powell's testimony tomorrow and Thursday in the U.S. Congress. So we'll watch this closely, but to me, the path of most pain would be that the Fed doesn't cut, and they don't cut as much as people think they're going to cut, and the market gets disappointed.
It is interesting because the posturing of President Trump has been such that it's politicized, significantly politicized, what the Fed's going to do, and that may enter into part of their decision making. If they choose to stand independent, they may actually hold back.
We'll find out. We'll find out soon at the end of the month.
Yes, we will. Okay. Now, our friend David Rosenberg, your former colleague from Merrill Lynch, well-respected economist, believes along the same lines that we do that a U.S. recession is probably not far away. And we do follow his daily commentaries, but he's certainly been riding that situation or that position for a little while, right?
Well, David Rosenberg is often called a perma bear, or a strategist or economist who seems always bearish or negative on the economy and the markets, and that is somewhat true at times. He's probably more bearish than bullish, but he is contrarian for sure. However, a lot of the things he's looking at, and quite frankly, the chart that we're looking at right now on slide 14 is not his. It really is a study, I believe, that is from the St. Louis Fed I can't remember, one of the Federal Reserve Bank of St. Louis or one of the Federal Reserve banks.
Yeah, it's the New York Fed, the New York Fed model.
New York Fed? Okay, the New York Federal Reserve Bank. And effectively, they're just looking at the shape of the U.S. yield curve and trying to predict the probability of the U.S. recession from that. But, you know, a picture's worth 1,000 words. It could very well happen. And then the question, Scott, becomes, too, is the Fed, even if the Fed does cut rates by 25 or 50 basis points, is it too little too late? Or are they going to be aggressive enough to save the U.S. economy and continue this record-long expansion?
Well, I would say that the strength in bond markets tells us one story. And we've talked about this in more detail last month, but the strength in stock markets tells a completely different story from what the bond markets are telling us. So it's going to be interesting to see how that reconciles. But one thing we do know is that the most recent economic data that's been released, which gives us some look at what's happening in the U.S. economy into the second quarter. We still have another month of data before we'll see exactly how that's all going to unfold. But at the moment, we're starting to see some lower estimates for GDP around the 1.3% level for the second quarter. Closer to home, tomorrow is also Bank of Canada interest rate decision day. At the last meeting and the last announcement, there really hasn't been any significant and conclusive data to suggest that they will move policy. They believe that the degree of accommodation being provided by current policy interest rate remains appropriate in taking any future policy decisions, that the governing council will remain data dependent. And as I said, I don't think there's been any significant data one way or the other to get the Bank of Canada to change, but they are being especially attentive to developments in household spending, in the oil markets, and the global trade environment. And just as an interesting twist, I decided to do a little research on the levels of confidence at the consumer level and at the business level. And interestingly, the consumer in Canada is actually quite confident, but businesses are going the other way. So I thought it would be interesting to compare which of these might be more leading as far as economic indicators are concerned. And if we look at the business confidence in Canada, you can see that it tends to lead GDP growth, whereas it's not quite as the correlations aren't quite the same when you look at consumer confidence. So just an interesting look at what might be driving Canada's annual GDP growth. Paul, any comments on either of those?
No, those are interesting charts, though. I don't really have any comments other than I wonder why the consumer is so bloody confident and businesses are not. Probably due to trade wars. I mean, we've got issues going on with China right now. Besides our steel sector with the U.S., we've got major issues in Alberta and Saskatchewan between canola and meat. Perhaps that's the reason why.
Yeah, and interestingly, the consumer confidence tends to move with wages and salaries. And I took a look at the wages and salaries, and there was an uptick in May in wages and salaries. So I imagine that has a little bit of an impact on the consumer confidence as well. But as we know, employment is a lagging indicator, and it'll be interesting to see if that holds. Back to David Rosenberg, another leading indicator, which he pointed out on Twitter today or yesterday. Just interesting that the global economy has moved into a downtrend economically, not at levels not seen since 2009. and that seems to be pretty similar to what's going on in the US. So that being said, and we can extrapolate from the US economy into what happens in corporate earnings. And as far as the S&P 500 is concerned, Paul, we're in an earnings recession, and that may actually continue if the economic environment continues to slow.
Yeah, I mean, technically, it's excuse me, a earnings recession, but will be interesting to see as second quarter numbers in the U.S. are going to start coming out like now in the next week or so. So it'll be interesting to see how second quarter earnings come up, but it's the path so far hasn't been stellar.
Yeah, and with earnings at earnings growth actually at lower levels, we've got stock market prices at close to all-time highs. So from our perspective, there's very little interest in putting new money into equity markets at current price levels. So that's why we remain cautious and defensive. We are continuing to be underweight in our equity exposure and waiting for price opportunities to develop before we put some of the overweight amount of cash that we have in our portfolios to work. And I think that's just being prudent. Paul?
Yeah, agreed. And if any of our clients would ask, well, if earnings have decreased the last two quarters, from the third quarter to the fourth quarter to the first quarter of 2019, why are stocks at their all-time highs in the U.S. or on the S&P 500? And the answer is because of what's called multiple expansion. So the market is prepared to pay what's called a multiple on the earnings, and it might be 15 times or 20 times. And if the market feels positive that the picture we're looking at now is going to transpire, where earnings are going to increase, they are willing to pay a bigger multiple today, closer to, say, 17, 18, 19 times as opposed to 14 or 15. So the reason why the stock market is higher today is because people are very positive about earnings increasing, and they're willing to pay that higher multiple. Doesn't mean they're right, but that's the reason why the stock market is higher.
And there you have it. Thank you for that. Okay, so that's it for this month. Thank you very much for taking the time to join us on and listen to the video, watch the video. Again, if anybody has any specific questions that they need addressed, we are here to do so. Please do not hesitate to get in touch with us. I know it's the summer months, and it's not necessarily at the forefront of everybody's agenda, but if there is anything that you need to discuss, please don't hesitate to get in touch with us. But that's it from us for this month, and we will be back again at the beginning of August with another update for you. Until then, have a great rest of the summer.